In 2026, a firm dollar and elevated US rates quietly raised the cost of the trillions in dollar debt owed outside America, a pressure that builds invisibly until something breaks. The last time a strong dollar broke the emerging world, 1997. This is that archive. This is an archive of the 1997 to 98 Asian financial crisis. Documented market data only. Not a forecast, not investment advice. Chapter 1: The Miracle Economies. Through the early 1990s, the Asian tigers, Thailand, South Korea, Indonesia, Malaysia and others, posted some of the fastest growth on Earth. Capital poured in. The story was that Asian growth was a one-way bet. Most of these economies pegged their currencies to the US dollar. The stable peg made it cheap and apparently safe for their companies and banks to borrow enormous sums in dollars. Chapter 2: The Hidden Fragility. Borrowing in dollars while earning in local currency works perfectly, right up until the peg breaks. The entire system depended on the exchange rate never moving. That is a bet on stability, not a hedge. By 1997, speculators saw that Thailand's reserves could not defend the baht peg against its trade deficit and short-term dollar debts. They pressed. The central bank spent its reserves trying to hold the line. Chapter 3: July 2, 1997. On the 2nd of July 1997, Thailand gave up and floated the baht. Having burned through its reserves defending the peg, it had no choice. The currency collapsed almost immediately. 50% plus Thai baht versus dollar within months of the float. Then came contagion. Investors looked at every economy with the same profile: pegged currency, dollar debt, thin reserves, and pulled out. Indonesia, South Korea, Malaysia, and the Philippines were hit in succession. Chapter 4: The Collapse. Indonesia was the worst hit. The rupiah lost around 80% of its value, banks failed, and the crisis became political. The IMF arrived with rescue loans tied to severe austerity conditions that deepened the immediate pain. South Korea, then the 11th largest economy in the world, needed a rescue package of around $58 billion. Economies that had been miracles months earlier contracted by double digits. Chapter 5: The Transmission. The mechanism was brutally simple. When the local currency halved, every dollar of debt doubled in local terms. The burden economists call original sin. Solvent companies became insolvent overnight purely on the exchange rate. By 1998, the shock had spread beyond Asia. Russia defaulted on its debt, and the giant US hedge fund, long-term capital management, collapsed and had to be rescued. A regional crisis had gone global. Chapter 6: The Aftermath. Asia drew one lesson above all: never again be at the mercy of foreign capital and the IMF. In the years that followed, these nations accumulated vast foreign exchange reserves as self-insurance. Those reserves were recycled heavily into US Treasury bonds, helping fund American deficits and hold down US interest rates through the 2000s. The crisis reshaped global capital flows for a generation. Chapter 7: The Pattern. The pattern the record shows. 1. Strong growth plus a currency peg. Invite heavy dollar borrowing. 2. Reserves can't defend the peg, it breaks. 3. Currency collapse doubles the debt. Original sin. 4. Contagion spreads to every economy with the same profile. This archive does not predict whether current dollar conditions will stress any particular economy. It documents what happened the last time a strong dollar met a world that had borrowed heavily in it. The archive stays open. This is what the historical record shows.